Welcome to the Pro Ticker Deep Dive. Today, we are going to dive into the world of energy infrastructure master limited partnerships, MLPs. For years, the sector's kind of been this, well, quiet backwater, financially speaking, often ignored by the big institutional money.
Right.
And maybe even looked down on by retail folks who got burned last time around.
Yeah, it definitely happened.
So the fundamental question, really, is this. Is the recent strength we're seeing in these pipeline and midstream players, is it a sign of a real quiet rebirth? Or is it just another head fake before they kind of slip back?
Well, our analysis suggests there's a subtle shift happening. It's meaningful, I think. Investor perspective is changing.
Okay.
These assets, they've been in the market's blind spot for a long time, partly because of that tricky tax structure, the K-1s.
Ah, the K-1s, yeah, it scares off a lot of funds.
Exactly. But the core story now, it's getting pretty hard to ignore.
Yeah.
We're seeing like three main factors coming together. One, real stability in global crude prices. Two, the growing structural importance of U.S. natural gas exports. And three, critically, just the sheer appeal of high sustainable yields when interest rates are, well, higher.
That K-1 point is key, though, isn't it? It explains why they often trade at a discount in the first place.
Absolutely. It creates a structural barrier for some buyers.
So our mission today, for you listening, is to really distill why these midstream giants, the companies moving and storing the physical energy, why they might be setting up as one of the more, let's say, compelling risk-reward scenarios right now. We need to figure out if this is the moment where, the fundamentals finally push past the complexity and that historical baggage.
Right. Let's start with the macro picture then. The energy stability part.
Okay, lay the groundwork.
What's interesting is how things have kind of settled down globally. Oil markets, remember how volatile they used to be?
Oh, yeah. Every headline moved the price.
Exactly. Now, we're seeing remarkable discipline. It's not by accident, though. It's largely, managed.
Managed by whom?
Disciplined supply from the OPEC Plus group, making sure the market isn't swamped. Plus, you've still got really solid demand, especially from Asia, as their economies keep expanding.
Okay, so oil is about stability. But you mentioned natural gas.
Yeah.
That sounds different.
It is. That's a story of pure structural growth. U.S. liquefied natural gas LNG exports are just booming.
And that's not just temporary.
No, this feels long-term. Think about Europe needing to diversify away from its old suppliers. That creates the sustained, multi-decade demand for American gas. We're becoming a really crucial global supplier.
So how does that feed into the MLPs, the pipeline guys?
Perfect setup for them. They're basically the toll collectors for energy, like FedEx for fuels.
Right.
They don't really take the price risk on the oil or gas itself. Their income is based on how much moves through their systems, volume, and reserved capacity.
So they get paid whether gas is, say, $3 or $5?
Pretty much, yeah, as long as the fuel is flowing.
And the contracts they use? They're pretty solid, right? Not just spot market stuff.
Exactly. The bulk of the revenue comes from long-term fee-based deals. Specifically, take-or-pay contracts. That's the gold standard here.
Explain that. Why is take-or-pay so important for stability?
Okay, so a take-or-pay contract means the producer, the E&P company, drilling the wells. They have to either ship the volume they contracted for, or they have to pay a fee anyway, just to reserve that pipeline space, even if they don't end up using it.
Ah, I see. So it protects the pipeline's cash flow from short-term hiccups.
Precisely. It gives them almost utility-like predictability. Plus, we're finally seeing some of those infrastructure bottlenecks easing up in places like the Permian Basin in Texas or Appalachia.
Right. More flow means more tolls.
More flow, more tolls, more reliable income.
So for you listening, what this boils down to is that these infrastructure stocks are starting to look like one of the few places to get real yield, cash flow that can actually keep up with inflation.
Yeah.
We're talking reliable dividend yields, often, 5% to 8%?
In that range, yeah.
Yep.
Sometimes higher.
Which is a huge step up from treasuries, but it's backed by these really stable, contracted revenues. They're looking like durable income plays again.
They really are.
Okay, so that's the macro foundation. Stable. But let's get into the market dynamics. Are investors actually, putting their money where their mouth is? Section 2, flows, fundamentals, and that lingering skepticism.
Well, the flows tell an interesting story. A market kind of in transition. We are seeing institutional money, think pension funds, income endowments, those yield-focused accounts.
The big players.
Right. They've actually turned net positive on MLP-focused funds for the first time in weeks. It's not a flood, mind you.
Okay.
But it's a definite rotation. These are the players hunting for dependable yield that can handle inflation, and maybe they're finally willing to deal with the K1 hassle to get it.
But there's a big contrast, right? Institutions dipping their toes in, but what about retail investors?
Ah, yeah. Retail is still very cautious. Our sources basically say they're still scarred by prior underperformance.
They remember the crash in 2014, 2016, when distributions got slashed.
Exactly, those huge losses.
Yeah.
That memory sticks. And it's probably why the sector hasn't totally taken off yet.
And maybe why they still look cheap.
That caution is a big part of it, yeah. You can see it in the valuations. MLPs are trading on an enterprise value to EBITDA basis below their 5-year average.
Even though the underlying business is stronger now.
That's the point. You're paying less for what is arguably better, more reliable cash flow than 5 years ago.
Okay, let's talk financial health then. You hear healthiest in years. What does that actually mean? How much better are the balance sheets?
It means they learned their lesson on debt. Big time. Deleveraging and capital discipline are the mantras now.
So less debt.
Way less. Historically, leverage ratios like debt to EBITDA were maybe 5.5x, 6x across the sector.
Which is pretty high.
Too high, as it turned out. Now the average is consistently dropping below 4x. Some big players are even aiming for 3.5x.
And that makes a difference, how?
It dramatically lowers the risk profile. Less debt means more stability, much lower chance they'd ever need to cut those distributions again.
Okay, so stable energy, better balance sheets,
Yeah.
attractive valuations. Yet, you said skepticism lingers. Why aren't those big ETFs and closed-end funds trading at premiums then?
That's the million-dollar question, isn't it? And it comes back to, I think, 3 things.
Okay.
1, the K1 complexity we talked about. It just locks out certain types of buyers. 2, that retail memory of past pain. And 3, institutional hesitation because of ESG concerns, environmental, social, governance mandates.
Ah, the ESG factor. We'll dig into that risk more later.
Definitely. But the result is that overall fund positioning is still pretty light. You see it in those ETF discounts. There's clearly value, but there's also still a lot of money sitting on the sidelines waiting for more confirmation.
Got it. Okay, let's pivot then. Let's look at the actual trade setup. The asymmetric opportunity where the potential upside seems bigger than the downside risk. Unpack the contrarian case for us in Section 3.
Okay, first thing, yield resilience. We mentioned yields north of 7%. But the key is, are they sustainable?
Right. Is it a real yield or a value trap?
Exactly. Because leverage is down and free cash flow is up, the average payout ratio, basically, how much cash flow they use to pay the dividend, is falling.
So they're covering the payout more easily.
Much more easily. It suggests those distributions are safer than they've been in maybe a decade. So that 7% plus yield looks pretty solid, not like a warning sign.
Okay, sustainable yield. What about growth? Isn't this mostly mature infrastructure?
Mostly, yes.
Huh.
But there is an explicit growth driver, the LNG boom.
Back to natural gas exports?
Yep. Companies with lots of assets on the Gulf Coast, especially pipelines and processing plants near the big export terminals, they are set for huge jumps in volume.
When?
We're seeing several massive LNG export projects scheduled to start up in 2025 and 2026. That gives you really clear, contracted volume growth visibility for years ahead.
So real growth potential too. And what does the better financial health allow companies to do?
Gives management options, flexibility. When the balance sheet is strong, they can return more capital to you, the investor.
Just bigger dividends.
That's part of it, yeah, increasing distributions. But also, we're seeing aggressive share buyback programs.
And buybacks help because
They reduce the number of shares out there. So each remaining share gets a bigger piece of the cash flow pie. It boosts value per share, even if the overall market multiple doesn't expand much.
Okay, that's the bullish case. Strong yield, LNG growth, capital returns. Sounds good, but now let's talk about the risks. The speed bumps holding back that full acceleration.
Right, there are definitely hurdles. The biggest structural one is still policy and ESG scrutiny.
Explain that.
Even with solid fundamentals, worries about political shifts like getting new pipelines approved or new regulations that still spook some investors. And the environmental angle.
ESG mandates.
Yeah. Big institutions with strict ESG rules often just have blanket bans on energy infrastructure. Doesn't matter how good the company is, they just can't invest. That cuts off a huge pool of potential capital.
Okay, policy and ESG. What else?
You still have commodity risk, indirectly, even though these guys are toll collectors.
Right, insulated.
Mostly. But if oil or gas prices do something really crazy like collapse or spike massively, it can still hit the sentiment for the whole energy sector.
So guilt by association, even if their cash flow holds up?
Sometimes, yeah. If their E&P customers are suddenly in crisis, It can create nervousness, even for the pipelines. Collateral damage.
Makes sense. And the last risk.
Rate sensitivity. This is crucial. MLPs compete head-to-head with bonds for income investors.
Because they both offer yield.
Exactly. So if the Federal Reserve keeps interest rates higher for longer, keeping yields on safe things like Treasury bonds elevated.
Like 5% on a 10-year Treasury?
Right. That makes the MLP yield less attractive by comparison. Why take the MLP complexity and risk for, say, 7.5% if you get 5% risk-free? That yield spread needs to stay wide enough to compensate investors.
So the whole thesis kind of hinges on the fundamentals being strong enough to overcome those hurdles, ESG, sentiment, rates.
That's a good way to put it.
Okay, let's quickly touch on the technicals. Section 4. Sometimes the charts tell you what the smart money is doing before it hits the headlines.
Yeah, a quick look at the price chart shows something potentially important. The main index for this midstream sector, it's consistently staying above its 200-day moving average.
And why is that significant?
That 200-day line, it's a big psychological level for long-term trend followers. Holding above it suggests the underlying trend is healthy. It also tends to act as support buyers step in when the price dips near that line.
Are there other signs of buying? Accumulation?
Subtle signs, yeah. Momentum indicators are sort of neutral to positive, not overbought, but not weak either. Suggests the market's digesting gains patiently, and crucially, trading volume tends to pick up on days the price goes up.
Meaning money is flowing in on strength.
It suggests buying conviction, yeah. Money moving in and sticking around.
So what could trigger a bigger move?
A decisive technical breakout. If the index pushes clearly above its prior highs from the last cycle, that could be the signal.
How?
It could force the hand of those systematic trend-following funds. The algorithms that have probably ignored MLPs since all the volatility back in 2020, if they get a clear buy signal,
They could pile in.
their buying could accelerate the upward momentum pretty quickly.
Okay, so let's wrap this up. The final synthesis here seems to be, well, asymmetric.
I think that's fair.
The downside risk seems somewhat limited as long as energy markets just stay reasonably stable like they are now.
Right. Equilibrium holds.
But the upside potential could be pretty meaningful if those institutional flows really start picking up, maybe driven by that yield hunger or a technical breakout.
Exactly. These MLPs, fundamentally, they're just cash flow machines. They offer predictable income, exposure to the stable part of the energy chain. It's really the opposite of all the speculative stocks dominating the news.
And maybe that predictability is exactly what the market needs right now.
Could be. In an unpredictable world, predictability itself becomes very valuable.
All right. The tide definitely feels like it might be turning. But here's a final thought for you, the listener, to chew on.
Okay.
The fundamentals look good, maybe great. Balance sheets are strong. Capital returns are growing. If this keeps up, how long can those big institutional investors, the ones tangled up by K1s and ESG rules, how long can they really afford to ignore this kind of value and yield? That tension, right, between their duty to get returns and those structural constraints. That feels like the key battleground for this sector over the next few years.
It's a powerful dynamic to watch. Absolutely.
See you all in the next Pro Ticker Deep Dive.